Now, when you're working with borrowers and lenders on new loans, are you seeing any trends in terms of the loan documents? Like, are we seeing a return to the complex structures that we used to have before 2007? Or are borrowers and lenders still keeping it simple and trying to just make everything easy for the next downturn? I hate to say.
Well, hopefully the next downturn will be like the last, meaning every 10 or so years.
Yeah,
so
yeah.
we don't see it really that bad. But your point is absolutely correct, that keeping it simple, plain vanilla. I don't want to suggest to you that it's a note and a mortgage and nothing else. I mean, there is mezz still out there, and as a matter of fact, I think there are some more companies out there that are looking at mezz as well as preferred debt within the structure of the entity.
Sure.
But we're not seeing 7 different levels of mezz. We're not seeing all this interaction between all these different parties within the capital structure, with the borrower coming down with relatively little. So, or I should say coming in with relatively little and not putting down that much. I think that we're seeing again, and it's a continuing theme, but I think again we're seeing that quality, and quality, therefore I can make the loan. It's much lower leverage. I think on top of that, you'll also have quality asset as well as quality borrower. We take a look at the capital markets, or even taking a look at the different insurance companies. Everybody's looking also to quality borrower. So all those come together. You're not coming up with all these different ideas to come in with monies at the property level, the mezz level, the preferred level, etc. That said, as you mentioned earlier today, you already said that there's also some competition amongst the lenders to get the asset.
Yeah.
And therefore, I think the more competition we see, I think we'll see a softening a little bit of that. I think we're going to see some leverage change probably, because to get the loan, you may bid a little differently. Interest rates, as we said, are still very low. So it's not going to really be interest rates so much pushing the transaction, because they're all within a certain band. But on the other hand, I think if we look at the quality of product, the quality of the borrower, and the relationship, I think we'll win the day. Crossing the T, dotting the I's. I think people are looking at underwriting a little differently, maybe a little tougher in terms of what they're looking at. I think the CMBS market will help drive some of that, because we've seen some proposals come out with new reps and warranties that have to be made.
Yeah.
That sometimes the capital market's going to have some money held back in the transaction. They're going to have to hold a position, if you will, and therefore they'll have, what people are saying, skin in the game. So I think that's coming about, and therefore I think that's what's also pushing that particular plain vanilla, because there's just more risk for the parties putting everything together. So yeah, I haven't seen that much yet in all the different levels and co-lender agreements and inter-credit agreements to the levels that we had with 8, 10 parties to an agreement, and how you have to come up with different parties' rights and different parties' abilities to protect their position. So, not there.
It's going to be really interesting to see how the CMBS market in particular works out once all the FDIC proposals that are out on the table right now are finalized and kind of signed and sealed, because I think there's a lot of confusion over, like you were saying, the risk retention or the skin in the game, and just things like with the reps and warranties, and what's going to happen with things like the operating advisor. So I think it's going to have a pretty interesting impact on the market. And
I think the market's already responding to some of that, not so much responding from lack of funds, thankfully, that we had before, but actually making increase of the government, making increase of what is the real necessity of whatever is being discussed and what's necessary, and at least there's some really good interaction between different industries and organizations to come up with the right answer to that.
Yeah.
It's not there yet, but I think that's another reason why on some level we're seeing more of a simplicity than all those different complex arrangements that we made in years past. Yeah.
To shift gears a little bit, I wanted to talk a little bit about the practice area at Latham and Watkins for commercial real estate. What issues are of most interest to your clients right now? What are you getting calls about? What are your clients concerned about or excited about?
Interesting question. It's interesting from the point of view, we're still getting some of the very same phone calls we've always gotten, whether it be insolvency, CMBS, the structures of the certificate holders who have interest in the bankruptcy case to make arguments or parties in interest. We're also seeing the conversations from the point of view of tax issues. Maybe to some extent people are focusing on it more than they did when it was a lot hotter in terms of the industry, but I think there's been a little different look that we didn't have before in terms of structure, to bring in our tax people, to bring in, as we talked earlier, the corporate people to help on M&A. So we're seeing a little more of that than we did before. I think that's also where the real interest is. I mean, we did the Carlisle Manor Care with HCP, and that took a significant amount of people at the firm to put together the team to get that done. And that's where the real fun might be, the real interest for the client to get into. But it hasn't changed that much. It's really interesting that insolvency is still pretty up there, even though we're not seeing a ton of bankruptcies. It's also the idea of structure it. How do you structure the pre-negotiation or forbearance agreement? So there's still that overlay that we're getting questions on. So between tax and insolvency, some corporate, in terms of real estate, we're getting more inquiry again in our joint venture. The excitement, if you will, when you say excitement, is that we heard that there's a construction loan in Vegas that they're going to be building. No. Believe it or not, yeah, we heard there's one out there. And we actually have 2 different casinos in the office right now that we're working on ground up. So it's kind of interesting that people are doing it, yes, but also if you're in an area where there really isn't that much competition, such as Vegas or what we've seen in Atlantic City take a strong hit, there's other interests out there. So that's where I think the, quote, excitement's coming from. Again, new construction, I think people get excited by it. And there is some money out there to finance it, whether it's be capital markets or it's going to be traditional on-book lending is going to be something that we're going to see coming forward. But those are the phone calls that we're getting right now. It's interesting that it's still, the warfare between the different holders of debt and how to bid it. And we just did a foreclosure down in D.C. and it was the property and the mezz. So if you start to think that way, that has not changed that much yet. We're still doing it. We're still seeing it. Maybe not to the same level we were, but it's still there. And as you said earlier in one of your questions, the stabilization that we're talking about, well, not everything is so stable, of course, and clients are still calling us on all those type of issues that we have to take care of.
It's interesting, just to go back to the new construction for a minute, we've from where we sit, we've seen a few new loans for, I think mostly apartment buildings, a couple office buildings here in the city. I think there's one down on Astor Place that's getting built right now. When you do hear about new construction, is it mostly in the apartment sector, office, or is it kind of more across the board?
I haven't seen that much of new construction, so it's difficult for me to answer the question that way. What we have seen in New York is some of the properties coming online. Wall Street Journal just had a nice article the other day. A client of ours, Stall Real Estate, built on the Upper West Side, and it's one of the best-selling buildings because they stuck to the roots of the type of building it was. It wasn't, just a glass structure with smaller space. They went ahead and tried to architecturally take into consideration the neighborhood, take into consideration larger space for families staying in New York. So they've been doing quite well. But these are projects that were started in the downturn, and they're coming online now. I don't really see that much in terms of new construction even happening in the apartment sector. Now, New York has a very, very strong rental market too, and I heard another building that was built for condos now being changed into, going to be modified to be a rental building because the demand is there. So does that mean people are going to start building again? Because there's a few different places in the city that they should. But what we also saw in new construction has also been healthcare, that we have seen facilities being built. I even saw out of nowhere a shopping mall that was looking for some financing, which was amazing. But I have not seen, I don't know that the sector has seen a lot of new construction, but the one that I told you about struck me was Vegas, that there's an actual construction loan being put together that I heard in Vegas. We're not working on it, but I heard about it. So does that mean the things to come? Does that mean it takes 2 or 3 years to to put it up and have it up and running? And maybe that's a good sign that people understand that the horizon looks a lot better than where we are today, which ties back into my theme of stabilization, meaning it's not going down maybe, it's not going to maybe raise that much, but at least we can see where we are in the market, and 2 or 3 years out, maybe it's better. But then your other question about Japan and the Middle East may put a damper on all that. So it's kind of an interesting group of questions that you have today.
And one last question. What's in the cards for Latham and Watkins Commercial Real Estate Group over the next year?
We've seen some more new loan originations. We have a few clients that are doing that now. We have a few clients that are still selling portfolios, properties or loans, more loans probably. But there we've seen that stabilization, that we've seen much more of that joint venture feel. So we see the two of those, but then also we have some private equity clients that we also see some movement. So if you have private equity and then we get back into mergers again, we think that that's what we're going to be seeing this year, because we've already seen an uptick in both. We've seen some funds being formed, which you have too, you've reported on them, substantial funds as a matter of fact, and they're going to be out there buying, and that will just create competition from other asset pools and classes. So therefore, origination, joint venture, private equity, there will be mergers and acquisition. I don't think to the level that we've seen in the past, of course, but if we still see a tightening of the market on IPO, I think we'll see more on the mergers, and if hopefully things keep stable, then maybe we'll see other movements in other sectors, such as, well, we've seen a little bit in industrial, but also maybe some retail, hotel for sure, and office. We'll see where that takes us.
Great. Thanks.
Thank you.
Thank you. And that's all the time we have for today. And I'm Samantha Rowan, and this is Refi TV.
Thank you.